Part 4. Monetary Policy in the United States. Monetary policies are actions taken by the monetary authority to reach specific macroeconomic goals, like price stability and stability of financial markets. The key idea behind monetary policy is that monetary authorities can influence interest rates and credit availability that, in turn, influence consumption and investment expenditures, the two largest components of total spending. Since prices and wages are sticky and adjust rather slowly, higher total spending results in higher economic activity and slightly higher inflation, while lower total spending results in slower economic activity and lower inflation. Monetary policy is very effective when the central bank has good control over interest rates and credit conditions, and when private investment and consumption are very sensitive to changes in interest rates. Because central banks cannot influence total spending directly, it takes time for monetary policy to affect output, employment, and inflation. The time it takes for a change in policy to influence the economy is called the effectiveness lag. In the United States, as stated in the 1977 Amendment to the Federal Reserve Act, the goals of monetary policy are price stability, maximum sustainable employment, and moderate long-term interest rates. The Federal Reserve pursues its dual mandate of price stability and maximum sustainable employment using two sets of tools called conventional and unconventional tools of monetary policy. The conventional tools of monetary policy are open market operations, reserve requirements, discount window policy, interest on reserves. The unconventional tools of monetary policy were developed by the Federal Reserve in response to the challenges posed by the financial crisis of 2008 and 2009. The unconventional tools of monetary policy are the expansion of the Federal Reserve balance sheet. This tool is often referred to as quantitative easing. Once changes in regular tools had lowered short-term interest rates down to zero, the Federal Reserve started using very large purchases of specific types of securities to directly lower long-term interest rates by altering the overall market demand-supply. The goal of this tool is to stimulate lending. Changes in the composition of the Federal Reserve's balance sheet. While traditionally the Federal Reserve had always traded short-term Treasury securities, in order to lower long-term interest rates and mortgage rates, the Federal Reserve focused its new purchases on mortgage-backed securities and long-term Treasury securities. Forward guidance. The Federal Reserve significantly increased the information it would provide to the public about its future intentions, hoping to help investors form accurate expectations for the future. In regular times, the Federal Reserve uses its conventional tools to influence its policy instrument, the federal funds rate. An operating target is a variable the Federal Reserve can fully control and that can influence short-term interest rates and money supply. The choice of the federal funds rate has consequences for the money supply. If the Federal Reserve wishes to maintain the federal funds rate at its target level for a while, it must inject reserves when the federal funds rate tends to increase and drain reserves when the federal funds rate tends to decline, losing control over the monetary base. Hence, either the Federal Reserve targets the federal funds rate, or it targets reserves and the monetary base. In the United States, it takes about 1 year for monetary policy to influence the level of economic activity, and about 2 years to influence the inflation rate. Monetary policy affects the economy through several channels. Monetary policy affects the real interest rate and fixed investment and consumption of durable goods. Monetary policy affects the value of the currency and asset prices, influencing net exports, investment, and consumption. Monetary policy affects bank deposits and banks' willingness to lend, as well as asset prices and firms' and families' ability to post collateral and borrow, influencing investment and consumption. In the United States, the Federal Reserve performs monetary policy with a clear attention to controlling inflation in the long run, however, not with an officially stated inflation rate target. Inflation targeting, Setting and communicating an explicit target for inflation and performing monetary policy so as to reach the inflation target at all times would not allow the Federal Reserve to pursue its dual mandate of price stability and maximum sustainable employment during periods of cost-pushed inflation. Because of the long-term lags between monetary policy actions and the inflation rate response, the Federal Reserve tries to be forward-looking. This strategy has been very successful at containing inflation and allowed the Federal Reserve some flexibility during recessions. This strategy, however, relies very heavily on the prestige and credibility of the central bankers. As discussed, if the central bank targets interest rates, it must adjust the money supply in response to fluctuations in what economists call the money demand, the amount of cash and liquidity the public wishes to hold at every interest rate. According to the Keynesian liquidity preference theory, people wish to hold cash and deposits in the bank because they need cash to pay for transactions. However, every dollar kept in the bank is a dollar not invested in stocks and bonds, securities that pay a much higher interest rate than any bank deposit. In economic parlance, the interest rate paid by bonds is an opportunity cost of holding money. Hence, according to the theory, at every interest rate, people wish to hold more cash when they need to cover more transactions, and at every level of transactions, they wish to hold less cash when interest rates are higher. When the economy is doing well and people have more transactions to pay for, they wish to hold more cash at every interest rate, and money demand increases. If people cannot borrow the extra cash from commercial banks, they get the cash from selling securities like stocks and bonds. As the supply of stocks and bonds increases, asset prices decline. Because there is a negative relationship between asset prices and interest rates, or yields, as asset prices decline, interest rates increase. Hence, more transactions lead to a higher money demand and higher interest rates, and fewer transactions lead to a lower money demand and lower interest rates. If the central bank wishes to keep interest rates somewhat stable, it must inject reserves and increase money supply when money demand increases, and drain reserves and lower money supply when money demand declines. Monetary policies are actions central banks or other monetary authorities take to reach some macroeconomic goals. In the United States, the Federal Reserve has a dual goal of price stability and maximum sustainable employment. Fiscal policies are discretionary actions a central government, in the United States, the federal government, takes to reach certain macroeconomic goals and influence the macroeconomic outlook. There are three tools of discretionary fiscal policy. The federal government can directly influence total spending by increasing or cutting its consumption and investment expenditures, or the grants it pays to states. Public transfers are direct payments to families and businesses, like Social Security pensions or unemployment insurance benefits. Transfers influence disposable income and consumption expenditures, the largest component of total spending. During economic downturns, the federal government can introduce temporary tax credits or tax cuts that can boost disposable income and consumption. Governments can also reduce economic fluctuations through the use of automatic stabilizers, properties of the tax system and the organization of public expenditures that automatically raise public expenditures and lower taxes during economic downturns, and lower public expenditures and raise taxes during inflationary periods. Progressive taxation and generous welfare programs would act as automatic stabilizers. Compared to most European nations, the United States has weaker automatic stabilizers. When evaluating the relative merits of employing monetary instead of fiscal policy, economists make three considerations. The first consideration is public policy and the real interest rate. While an expansionary monetary policy tends to lower the real interest rate, stimulating private investment, an expansionary fiscal policy tends to increase the real interest rate, depressing private investment, an important phenomenon called the crowding out effect. Typically, government pays for its expansionary fiscal policies by issuing new debt. As government increases its borrowing, the supply of loanable funds declines, and the real interest rate increases, crowding out private investment. The second factor to consider is fiscal policy at all effective? Some economists believe that fiscal policy is quite ineffective at stimulating the economy. They believe that when government purchases increase, even if the increase is paid by issuing new debt, families anticipate that sometime in the future they will have to pay higher taxes to lower the national debt, and therefore decide to increase their saving and reduce consumption. The third consideration is time lags. Fiscal policy and monetary policy suffer from different time lags. Monetary policy is fast to decide and implement, but has long effectiveness lags, while fiscal policy has long implementation lags, but once implemented, it reaches the economy faster than monetary policy. In 2008 and 2009, the world financial sector experienced a severe financial crisis that triggered a deep economic downturn that economists and commentators have labeled the Great Recession. A housing market boom and bust, financial innovation, and problems of moral hazard at loan originators and at credit rating companies all contributed to the crisis. In the 2000s, financial innovation had channeled trillions of dollars into the market for mortgage loans, increasing the demand for new and existing homes and inflating home prices. Financial intermediaries had found a way to bundle individual mortgage loans into a new type of bond called a mortgage-backed security. This process, called securitization, was meant to lower risk, but instead, it reduced mortgage originators' incentive to carefully screen mortgage applicants, so that mortgage-backed securities ended up being backed by shaky and risky mortgages. Soon, financial intermediaries started using mortgage-backed securities to build other complex collateralized debt obligations, CDOs. As more and more complex securities hit the market, credit rating agencies that were earning huge fees advising financial firms on the most profitable way to structure these new financial instruments found themselves in a conflict of interest, and their ratings lost all accuracy. Investors and financial intermediaries who saw mortgage-backed securities receive high ratings thought that CDOs carried little risk and invested heavily in these new obligations. When home prices started falling in 2006, many homeowners could not afford their monthly payments anymore and started defaulting on their mortgages, bringing down the value of mortgage-backed securities. Financial intermediaries were heavily invested in these types of securities, which they commonly used as collateral to borrow short-term. As the market for mortgage-backed securities collapsed, some investment banks saw their assets vaporize as they had to engage in fire sales of assets to keep liquid. In the United States, the first sign of serious stress came in January 2008 when Countrywide Financial Corp., the largest mortgage bank in the country, failed and was sold to Bank of America. Then, in March 2008, Bear Stearns, an investment bank and brokerage firm, collapsed and had to be sold to J.P. Morgan at a tenth of its value. The most dramatic events, however, took place in September 2008, when within a few days, 1. The investment bank Lehman Brothers failed, 2. Two large government-sponsored enterprises, GSEs, Fannie Mae and Freddie Mac, that provided credit to the housing market repurchasing mortgage loans, were taken over by the Treasury, and 3. America's largest insurance company, AIG, had to be rescued by the Federal Reserve. The Federal Reserve and the Treasury took exceptional steps in response to the crisis to prevent financial contagion and to support liquidity. Starting in 2007, the Federal Reserve injected liquidity, lowering the discount rate, and opened several lending facilities where non-bank financial intermediaries could borrow funds or swap securities, and where foreign banks could swap domestic currency for dollars. In 2008, the Bush administration passed the Economic Recovery Act that authorized the Treasury to spend $700 billion to get troubled mortgage-backed securities off financial intermediaries' balance sheets, or to support their capital in other ways through the Troubled Assets Relief Plan, TARP. In 2009, The Obama administration passed the American Recovery and Reconstruction Act, a $750 billion stimulus package to be dispersed over 3 years. This concludes Peterson's DSST Money and Banking instructional videos. Good luck on your DSST exam!